Assalamualaikum and good morning, Madam Rohayu. On behalf of Group 2 from CS2622E, I would like to introduce our team. Ahadi Akif, Amirul Nazri, Muhammad Fakrazi, Muhammad Takif, and my name is Muhammad Nasr Hazi. We are from the Bachelor in Actuarial Science program, and we are presenting our analysis for Financial and Management Accounting ACC466. Today, we will be comparing the profitability ratios of Power Berhad and HSIB. We hope you find our presentation insightful. Thank you.
Before we begin the financial statement analysis, here's a brief introduction to Seng Industries Berhad. Seng Industries Berhad was established in 1958 and is headquartered in Batu Pahat, Johor, Malaysia. The company is one of Malaysia's well-known food manufacturers, specializing in biscuits, especially its signature cream crackers, as well as a variety of other biscuits and instant beverage products. Next, we will move on to the Root Power Berhad background overview.
Moving on to the next company is the Power Root Sengren Berhad. Power Root Sengren Berhad headquarters is located in Kuala Lumpur. They are established since 1999. That is mean it's already 27 years of heritage. The main product of this company is they are selling coffee and energy, such as Tongkat Ali, the most famous one.
Next, let's look at the current ratio, which is a liquidity ratio. The formula is current assets divided by current liability. This ratio measures a company's ability to meet its short-term obligation using its current asset. Generally, a current ratio above 1 indicates good liquidity. For Power Root Berhad, the current ratio is calculated as 312.47 million divided by 112.32 million, resulting in a current ratio of 2.78 times. This means that for every 1 ringgit of its current liabilities, Power Root has 2 ringgit 78 cents of current assets available to cover those liabilities. For Seng Industries Berhad, the current ratio is calculated as 159 ringgit 87 million divided by 75.78 million ringgit, resulting in a current ratio of 2.11 times. This means that for every 1 ringgit of its current liabilities, Seng has 2 ringgit 11 cents of current assets available to meet its short-term obligation. Comparing the two companies, Power Root has a higher current ratio of 2.78 times compared to Seng, 2.11 times. This indicates that Power Root is in a stronger short-term liquidity position. However, both companies have current ratio above 2, suggesting that they are financially sound and capable of meeting their short-term liabilities comfortably. Next, we will look at the Q ratio, also known as the acid test ratio. The formula is current assets minus inventory divided by current liability. Unlike the current ratio, the quick ratio excludes inventory because inventory may take longer to convert into cash. Therefore, it measures a company's ability to pay its short-term liability using its most liquid assets. For Power Root Berhad, the quick ratio is calculated as 312.47 million minus 117.222 million divided by 112.32 million, resulting in a quick ratio of 1.74 times. This means that for every 1 ringgit of its current liabilities, Power Root has 1 ringgit 0.74 cents of liquid assets available to settle for its short-term obligation. For Seng Industries Berhad, the quick ratio is calculated as 159.87 million minus 35.78 million ringgit divided by 75.78 million ringgit, resulting in a quick ratio of 1.64 times. This means that for every 1 ringgit of its current liabilities, Seng has 1.64 of liquid assets available to meet its short-term obligation. Comparing the two companies, Power Root has a slightly higher quick ratio than Seng, with a difference of 0.10 times. This indicates that Power Root is in a slightly stronger short-term liquidity position. However, since both companies have quick ratio above 1, they are both considered financially healthy and capable of paying their current liability without relying on the sale of inventory.
Next, I will continue to the part profitability. So I start with net profit margin. This ratio tells us how much profit a company keeps from every ringgit of sales after all expense. So after the calculation, Powerroot keeps 99 cents out of every ringgit in sales, while HSIB keeps about 96 cents. Both are exceptionally high, meaning both companies have very tight cost control. However, these figures are unusually high, suggesting very low operating expense or unique business model. Perhaps they are holding companies or have minimal direct costs. So next is gross profit margin, which focus only on the cost of goods sold before other operating expense. So after the calculation, Power's gross margin of 98.08% means it costs to produce good is only about 2% of sales, very efficient. HSIB, however, shows 0% of gross profit. This is a red flag. It like means HSIB cost of goods sold equal its total sold sales, leaving nothing to cover other expenses. Alternatively, there may be a data error or HSIB might be a service-based company where cost of sale is recorded differently. This requires further investigation. So now, return on asset measure how efficiently a company use its total asset to generate a net profit. For every ringgit of asset, Powerus generates 6.5 cents in profit. HSIB generates 20 cents, more than 3 times higher. This tells us HSIB is far more efficient at using its asset to produce earnings. HSIB higher ROA suggests better management, faster inventory turnover, or a leaner asset base. Finally, ROCE, which is return on capital employed, show how well a company uses its long-term capital, asset minus current liabilities, to generate operating profit. Power Roots yields about 11.4 cents for every ringgit of long-term capital employed. HSIB earns 36.5 cents, again, significantly higher. This confirms that HSIB is not only more efficient with asset but also with its long-term funding. A higher ROCE is generally preferred as it indicates better returns for shareholders and lenders.
Next, I will present 3.0, which is efficiency ratio analysis. Efficiency ratios measure how effectively a company manages its resources to generate sales and operate its business. In this section, we compare Power Berhad and HSIB using three efficiency ratios. First is the inventory turnover ratio. For Power Berhad, the inventory turnover is approximately 1.72 times, while HSIB recorded about 8.2 times. A higher inventory turnover indicates that a company is selling and replacing its inventory more efficiently. Therefore, HSIB performs better than Power Berhad because it turns its inventory into sales more than 8 times a year compared to only 1.72 times for Power Road. This suggests that HSIB has better inventory management and lower holding costs. Next is the average collection period. Power Berhad has an average collection period of approximately 78 days, while HSIB takes around 38 days to collect payments from customers. A lower average collection period is preferred because it means the company collects cash faster. Based on these results, HSIB is more efficient in collecting receivables, which improves its cash flow and reduces the risk of bad debts. Lastly, the total asset turnover ratio. Powerroot Berhad recorded a total asset turnover of approximately 0.81 times, whereas HSIB achieved about 1.58 times. A higher total asset turnover indicates that a company uses its assets more efficiently to generate revenue. Therefore, HSIB again shows stronger performance as it generates 1 ringgit 58 cents of revenue for every 1 ringgit invested in assets, compared with only 81 cents for Power Berhad.
Assalamualaikum. My name is Muhammad Takif. I will be explaining about leverage. So for this slide, specifically about debt ratio, the formula is total liabilities over total assets times 100%. So for the Power Root Berhad, we'll get 41.75%, and Hapsang Industries Berhad will get 33.46%. So as we can see, for Hapsang, we have a lower debt ratio. So Hapsang Industries considered have lower financial risk. For the next one, I'll be focusing on debt to equity ratio. So the formula is total liabilities over total equity times 100. Okay, for the Power Root Berhad, we'll get 71.70%, and for Hapsang Industries Berhad, we'll get 50.29%, which means Power Berhad have a stronger financial position. And last but not least, we'll be focusing on time interest earned. First thing first, we need to find profit before taxation. We add with financial costs and we'll get EBIT, which means earning before interest and taxes. When we got the amount of EBIT, we divide it by financial costs. And for Power Root Berhad, we'll get 12.52. For Hapsang Industries Berhad, we'll get 21284.47. In conclusion, Hapsang Industry Berhad has a stronger interest paying ability, while Power Root Berhad has a relatively lower ability to cover its interest expenses.
Lastly, for the conclusion, based on all the financial ratios we have discussed, if I had to choose one company to invest in, I will choose HSIB. Although Powerroot performs well in some areas, HSIB shows stronger overall performance. It manages its inventory and assets more efficiently, collects cash faster from customers, and has lower financial risk because of its lower debt levels. These strengths suggest that HSIB is financially healthier and has better long-term potential. Therefore, as a potential investor, I believe HSIB will be the better investment choice. That's all from us. Thank you.